Hi there, Internet. My name is ᴜsᴇғᴜ and I'm one of eToro's most copied popular investors. Last week I put out an article in eToro talking about where I thought the market had been, where we currently were, and where we were going to. Because of time constraints, this was admittedly an abbreviated version of what I really wanted to say, but I wanted to put something out there that gave some context to the market movements at the time, just so that people would panic a little bit less. And so this article, which is available, talks about the broad strokes of where we've been, where we are, and what I think will happen next. You can read it on eToro, but today's video is about me diving into some of the detail that was contained in this diagram. It's going to be a bit of a long one, so I hope you're ready, and let's jump into it. Now, consulting my crystal ball, on the far right you'll see where I think the world will end up. And on the far left, because we need a baseline in what we know, that's where we've been. And smack bang in the middle is more or less where we find ourselves today. Of course, I can't show every possible influence in the world on one diagram. It would just be too much. So I have summarized it and taken a few liberties. Also, just note that these lines aren't to scale. So for example, I don't know exactly when these things might happen on the far right. I just know that they will happen somewhere in 2021. All right, so starting at the beginning, we know that there was a pandemic. We know that markets dropped in March of 2020, and we know that subsequently there was a great lockdown. Off the back of this, there were some surprises, but looking back, it feels a bit obvious, but I don't think at the time everyone anticipated perfectly how the world might change through the rest of 2020. But some businesses did very well. Because of the types of business, everyone stayed at home, their revenues and their profits increased, and subsequently their stock prices increased. And they deserved these increases in stock prices because the fundamentals of their business had improved. And that was great for them up until a point. And this is because the stock market, in both directions, is irrational. And so those stocks were overbought because people were enjoying the magnificent gains they were getting, but we'll come back to that in a moment. On the other hand, some businesses did very badly. We know the types of businesses: travel, hospitality, anything that had a business that required people to go out and do stuff, to travel, to interact, etc. Their revenues and profits dropped. Some of them had nothing, right, for a long time. And their stock prices dropped quite a lot. Some of them were at risk of failing. And then some of them, their stock prices towards the end of last year, they rose a little bit as people anticipated a world opening up in the distant future. At the same time, governments around the world started issuing implementing fiscal stimulus programs, and these took a number of forms, but one part of what they did was that they dropped interest rates. Almost everyone did this. When interest rates drop, it means that the cost of acquiring debt drops. So instead of paying 10% for a loan, you might pay 1% or 0%. So more people borrow money, more companies borrow money, and they use this money to grow and to buy things. And that means that globally within an economy, you tend to experience more growth. Something that wasn't really very well anticipated, at least not by everyone, is that personal savings would increase. So even though online retail enjoyed a huge boon last year as people bought more and more stuff online, there were still things that people wanted to buy that they couldn't. So sales and things like houses, cars, travel, holidays, they all rapidly decreased, and people were unwilling to or unable to spend this money anywhere else, so they started saving it. And the amount of savings that people experienced is massive. I don't know if anyone's seen the graphs, but there is so much pent-up money in personal savings right now. I'll come back to inflation expectations fall, but the demand for oil dropped off a cliff with things like travel massively reduced. A lot less oil was needed in the world, and less demand means prices drop. And actually, the price of oil, for those that watch the news, went negative briefly last year. And inflation is largely tied to the price of oil, by the way. Investors rushed to the safety of bonds. I'm not going to go into what bonds are right now, but bonds that were issued by governments, particularly the US government, were in high demand, which bonds typically are, because governments issue these bonds and guarantee that they will repay them. And so a lot of bond types are seen as riskless assets, and when things took a big dive in the first quarter, second quarter last year, people desired a lot less risk, and so they ran to the lower risk assets. Expectations around inflation really dropped off because investors were anticipating a world that was spending less money, and with the drop in oil prices, people saw inflation being at all-time lows. And then we all know that the world fell into a global recession, so almost all countries in the world were in a recession, which is there are some rules around what a recession is, but effectively it means that the GDP of a country, the output, shrinks. And then late towards last year, we had some really good news around vaccines and their effectiveness and the production of those vaccines. Something else that kept markets buoyant was that Q4 expectations were very high. So going into the Christmas period and the period where we have Boxing Day and all the sales and everyone's buying stuff for Christmas and all the other holidays, everyone knew that a lot of technology companies, the biggest technology companies, would benefit from Q4. And this kept stock prices up, it kept everyone's expectations up, it kept sentiment up. And when the earnings reports arrived for those companies, everyone was more or less proven right. Those companies did fantastically through Q4. But even before this happened, I think the more seasoned investors were already growing nervous. They knew that a lot of the tech companies and other companies that had benefited from the lockdown were looking very, very expensive. And so the beginnings of that nervousness were found in the market. And this was, a month ago, month and a half ago, 2 months ago, when people started talking about bubbles. Bubbles, bubble, 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 bubble. We all saw the headlines, we all grew tired of the headlines, and the market continued going up. But we also knew that the world was going to be opening up, and that there were lots of stocks that were looking very cheap. Those companies that hadn't gone bankrupt would benefit massively when the world did open up, and the stock market is kind of a vehicle for seeing into the future. And so stocks and those companies that would benefit from an opening up world began to rise as investors started looking for other things that weren't as overpriced as some of these technology stocks. And money started going into different geographies, because also the US, there was a concentration of money in the US markets. And so the money started going into other sectors within the US, but also other geographies, like in the UK and Europe. Now, as it started becoming evident that the stimulus and the work that the global governments had been doing was working, and that the outlook for the coming year was beginning to look pretty good in terms of economic growth, expectations around inflation began to rise. And investors started looking for little hints of inflation rising. Demand for oil has also been increasing, and so the price of oil, I think it was negative slightly next year, now it's over $60 a barrel, has increased significantly, as has the price of other commodities. Now, in a world where investors expect the economy to do well, they don't want to be in bonds, because bonds give really low returns. So they want to move money from their bonds into other things that are going to give them higher returns, especially if inflation is going to rise, because inflation eats the value of money. And if you've got your money in a low return vehicle, inflation could be more than the return you're getting in that vehicle, and then the value of your money is decreasing anyway. So investors started selling bonds, and when investors sell bonds, there's less demand for bonds, the price drops, and when the price of bonds drop, the yields increase. I'll create another video about bonds and explain them in the simplest possible terms. They are very important to the overall market. The important thing to bear in mind, and I think people have forgotten this through the past few weeks, the most important thing to bear in mind, in my opinion, is that investors are selling bonds because they think the economy is going to be excellent. All right, I'll say it again so that we remember this. Investors are selling bonds because they think that they will make more money by investing in other parts of the economy, because they think that the overall economy is going to be fantastic. And when you keep this thought in mind, it feels kind of silly to panic through the correction that the market has recently experienced. The market has sold off because investors think the economy is going to do well. And taking this thought another step, do you think the economy growing means that stock prices are going to fall further? That's just an absurd thought. There is no way that a growing economy means that the overall stock market is going to fall. So it is very likely that as the economy grows, like investors expect, the stock market will also rise. Now that doesn't mean that the same stocks in the stock market will rise. It's probably going to be a little bit different, but the overall market will continue to grow. This is not the end of the world. The sky is not falling. All right, so where were we just before here? So investors panic as a future with high inflation cripples growth. So again, investors panic. Oh no, high inflation means my high growth stocks are screwed. And so they start selling high growth stocks. Money initially rotated fairly casually into value stocks and recovery stocks. And that was quite obvious. We could see it in the prices of individual stocks, as well as the indexes that will kind of represent various sectors. The bond yields started rising as more and more money left the bond market to find new homes. And the bond yields spiked, fueling more fear about growing inflation, which fed the panic of high valuations in tech. And eventually, the overall market panics. Now, because companies like Apple and Amazon and Google, which all benefited during the lockdown, are such a large part of the indexes and the market overall, when they sell off, they bring the indexes down by a material amount. When the indexes fall, people start fearing the worst, and they start selling all their other stuff along with the very expensive stocks. And so we started seeing selling across the board, maybe less so outside of tech, but selling across the board in some sectors that really didn't need to sell off at all. This panic feeds on itself for a while. Algorithmic traders, they get the signal that the market's selling off and they sell off, and when they sell off, everyone else sees the market falling further. Panic, 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 panic. And people get into a tizzy. If we're able to keep calm and know that this is panic and not necessarily justified, at least to the degree that it happens, a lot of opportunities start appearing. And so the market, it always bottoms out, right? The market will find a bottom. I don't know if we're there yet. I mean, if you look at this, it feels like the selling is slowing down, but I don't think we have enough evidence just yet to say that it is slowing down. And so we begin taking advantage of things that are cheap. The market might continue to fall a little bit, so things that we buy that are cheap, they might fall a little bit more, but ultimately we buy them at a price where they will at some point experience growth. We keep a bit of cash on hand so that we can continue buying until we do find a bottom. Bond yields will settle. This is an assumption, by the way. Bond yields might not settle. I could be wrong and bond yields keep on going up like crazy, in which case I expect governments to step in and do something. They might do it anyway, but so if they don't settle, someone will step in and help them settle, probably. If they don't, then we need to see what happens. But this is the most likely path I see at the moment. There are lots of other scenarios that could play out, and there would just be too many to create in one drawing. Okay, so you are somewhere around here. The market is panicking, and we're finding a bottom somewhere in this mix. Now it's becoming spring in the northern hemisphere. The world is starting to open up. The vaccine programs are doing very, very well, better than some expected. I think that we might have too many vaccines, an oversupply of vaccines, but we'll see how that plays out and who that hurts and who it doesn't. But what I do see is this massive amount of money that's been saved, as well as this huge amount of stimulus pouring into the market. consumer spending is going to massively increase. Businesses that are the beneficiaries of investors' money, so the recovery stocks, will have more money to spend. Sales will be through the roof. Stock prices are going to go absolutely crazy, I think, for this part of the economy. What I don't think everyone realizes, maybe I'm wrong, but I don't think so. Otherwise I wouldn't be saying it, is that money will find its way back into growth stocks. I think it might start doing that quite soon, actually, after the bottom. It might not distribute itself all the way across growth stocks. So I would think that the FANGs, the mega cap tech companies, they're seen as relatively safe. They've got fairly steady growth. Money will probably go into them first. I'm not so sure. The Chinese market, especially Chinese tech, has had a huge sell-off recently. My guess is that a lot of money is going to find its way into that set of stocks too. Anyway, but overall, growth stocks, they do benefit somewhat after this bottom is found because they're cheaper. They're maybe not cheap, but they are cheaper. The price of oil will continue to rise, I expect. The economy will continue to grow. If you look at the outlook here, 2021 is expected to be a very good year across the board. The picture for emerging markets is quite interesting. And then 2022 is also expected to be another growth year. Now, don't take these forecasts as written gospel. Things could go wrong. But right now, this is the best information we have. Lots of smart people and analysts have worked on this information. It's a relatively independent organization, so I think we can trust it as a snapshot at a point in time. And so as the economy continues to grow, and people continue to spend money, inflation is likely to continue to rise. And so through these years, most developed nations, and from what we can see here, many emerging markets and developing nations, they continue to see their GDP grow. Now, what happens beyond this is much more of a question mark. The further out we go, the more uncertainty we're dealing with. So it's likely that somewhere in here, because inflation will probably rise, that we will see money running back to safe havens, inflation safe havens, or inflation hedges. Maybe it doesn't pour initially. Maybe it's just, a steady drip into those kinds of areas. So gold and gold miners would be some of the beneficiaries, as would some currencies. We're also going to see a tapering of stimulus. I don't know when. I don't know if it'll be in 2023, but slowly but surely, global governments will start retracting the support that they've given the economy. I expect any jumps in this, the news of this, will probably affect markets negatively. So we might see pullbacks or corrections when that happens. A question that I have is, when inflation rises, is it going to rise? I don't think it'll rise to hyperinflation levels, but it might become quite high and quite suddenly. And if that happens, what then? Any sudden movements by any of these economic levers will shock the market. I think ultimately 10 years down the line we'll be fine, but we're trying to make money off of the shorter term moves, so we need to be aware of these. So I think the most likely scenario we find ourselves in a few years from now is that we have reduced stimulus, rise in inflation, rise in yields, strong economy, interest rates are increasing, so the cost of borrowing is becoming more expensive. Growth stocks will probably still be in favor, because when it comes to it, technology is going to be the growth vehicle of our world for the next 2 to 4 decades, right? Maybe even longer. And inflation hedges are growing. So it's at this point, this far out, that I start looking at the trends that I think might emerge beyond the economic impact of what we've been through. All right, that was long-winded. That was a long video. I hope that helps you understand a little bit more where we've been, what that means for us right now, and what it might mean for us in the next few years. And this is the kind of information that I will use as an input that affects my portfolio strategy. All right, I'll speak to you soon.